First day of trading, January 2022. If I were to start my investment career over, what would I do right now with $1,000? Could go to Wall Street Bets, be an ape, go on Robinhood, YOLO it on Tesla or Bitcoin. What I chose to do was go to Charles Schwab and open up a brokerage account. I would have preferred a Roth IRA, but I already have one. So I'm going to simulate with real money what I would do right now, today, with $1,000 beginning to invest. Okay, here is my brokerage account with Schwab. I opened up under the name of YouTube. Funded it with $1,000. And now, what do I do with that money? Could leave it in cash, expecting perhaps with markets at an all-time high, maybe they're gonna dip and buy the dip. Don't know if that's gonna happen. They've been calling for that for a year now. All last year, all 2021, they were calling for a correction, calling for a correction. Every time the market dipped 2 or 3%, people went in and bought the dip. Underneath the FANG stocks, say the S&P 500, the FANGs, Facebook, Amazon, Apple, Google, Microsoft, if you add them to the FANG, Netflix, those 6 or 7 stocks have held up the S&P 500. But beneath those stocks, with the rest of the 500, 550 stocks in the S&P 500, there's been a churn where most of those companies have experienced at least a 10% correction. But the FANGs have held them up. So I'm not really expecting much more than a 5% correction this year. And the whole time you're out of the market, you're missing potential gains. We have no idea if the market's going to go up or down this year. So what I'm doing is going up here to research, Oh, Schwab will let me. And there's really two choices. I'm not going to pick an individual stock. It's too risky if I only have $1,000. Could do mutual fund or exchange traded funds. I'm going to look at exchange traded. The reason for an exchange traded fund is they're very, very cheap. We're going to look at the Spider first. SPY is a indexed fund linked to the S&P 500. If you scroll down here, you can see 0.04%. 4 basis points is what you are charged to be in this fund. Very low portfolio turnover. It is not actively managed. This ETF is simply meant to reflect what the S&P 500 does. Very, very cheap way of investing in the S&P 500. And you can see the Morningstar ratings. You can see the stocks over here that it holds. Apple, Microsoft, Amazon, Google, Tesla, Facebook, Google Class C, it's another one. That's why there's 550 stocks in the S&P 500, not 500 because some companies have more than one. Berkshire Hathaway. So it's set to simulate the S&P 500. The problem is I only have $1,000 and this stock price is 476, and I don't want to put half my money into the S&P when it's at it's probably going to be an all-time high today. Another option is iShares, IVV. Same situation, except it's iShares. Um, again, whoops, we're going to close that little snapshot. Not actively managed, 0.03%, little cheaper to run. Performance is better on the Morningstar ratings. Same basic group of companies as the previous one because they are all linked to the S&P 500. But again, I don't want to put half my money into one fund the first day of the first trading day of the year. So another potential investment would be a mutual fund. The problem with mutual funds is they can be expensive. These top two are my two favorite. T. Rowe Price, large U.S. growth fund. Now, as you can see, year to date, and this would be last year to date, the fund did not do well. If you look at a 3-year average, the fund also did not do well. So you have the S&P Trust. The light blue is the large growth as a company, and the dark blue is T. Rowe Price blue chip on its own. Go back 10 years, it has greatly outperformed. 5 years, greatly outperformed. 3 years is my favorite one to look at, statistically speaking. Past performance is not a predictor of future performance, but what a mutual fund or stock or company did in the 3-year, if you look at a 3-year horizon, it's probably going to be more accurate predictor of the future 3 years. Now, there's one problem. Well, there's a couple problems with that. First, let's look at the expenses. Instead of 0.03 or 4, it's 0.68. So it's more expensive to be in. It is actively managed. And one thing I don't like is the current manager has only been there since October of last year, 2021. Normally, I do not invest in a fund unless the manager has also been there 10 years, because this guy does not get credit for the 10-year, the 3-year, the 5-year, or the overall rating. That was all someone else. But I have been in this fund for a long time. I'm a little hesitant because this guy is new. But again, you're looking at the same group of stocks: Amazon, Apple, Facebook, Alphabet, PayPal, some other ones. The biggest loser right now is PayPal by the looks of it, and that is what it is. But this is one that I'm going to buy. I'm going to buy that right now. And what I'm going to do, I have $1,000. I am going to purchase this. I'm only going to put $50 in. And I'm not going to reinvest anything. I like to get the cash back and decide after I get the cash, what do I want to do? Now, another problem with a mutual fund, I have no idea what I'm paying for this fund per share right now. If you go to an ETF, you can tell. With a mutual fund, you cannot tell. This is called dollar cost averaging. Oops, it's a minimum of $100. I guess I'm putting in $100 into this one fund. Place order. Status. It will close at market when the market closes at 4 o'clock. So we have no way of knowing. I have no way of knowing what I just paid for that stock. But that was me investing $100, 1/10 of my money into a mutual fund that I expect to hold the rest of my life. It's a good fund. Another one that I was looking at, and actually this is another one I was going to do until I ran up against the $100 minimum. The other one I like is Landis. Again, you see last year it underperformed. Go back 3 years and it outperformed. Manager, again, still short. 2013, I would have preferred a manager there. Well, that's 9 years. That's pretty close. But also highly rated. In fact, and again, the same similar stocks that were in T. Rowe Price. I like this fund too. I have a lot of money in this fund in my other accounts. And maybe next month, when I put another 10% of my money in, it'll be this fund. I will speak more in future videos about what a Roth IRA is, what an IRA is, what a regular brokerage account is. We'll talk more about the different kinds of ETF versus mutual fund versus owning a stock. If you enjoyed this video, understand it's my second one. The first one was a bit of a troll. You can watch it too on this channel. But if you enjoyed this video, please like, share, and subscribe. Help me build this channel. I would like to add my voice to the other investor channels on YouTube and Rumble. I'm also on Rumble. I'm loading them there. And hopefully maybe show a middle ground, a little different from what the other guys are doing. And I'll talk about them too. Give me time. I'm working on it. I'm learning. Help me build this channel. Peace out.